This video will discuss and compute the retained earnings breakpoint to determine when to issue common stock to finance projects. We'll work two examples employing the weighted average cost of capital and breakpoints. So what exactly is a breakpoint in retained earnings? Well, a breakpoint, let me calculate it first and then I'll interpret it. It's going to be 1 minus the payout ratio times net income divided by equity share, which is equity fraction, often called equity fraction. This is your target capital structure percentage for equity, common stock. This is 1 minus your payout ratio here. And remember what payout ratio is. It's your dividends per share divided by your earnings per share. It's the percent you pay out of your earnings in the form of dividends. And so if your earnings per share, let's say they're $1, and you have dividends of 25 cents, then 25 cents divided by $1 means 0.25 is what you're paying out in terms of a dividend, 25% of your earnings, which means this guy right here must be your retention ratio. And when you multiply it by net income here, it's how much earnings you are keeping and retaining in the business for a given year, because net income will be on an annual basis. So this is the amount of retained earnings that a firm will accumulate in a given year. When you divide it by the equity fraction, you get this breakpoint. The breakpoint is the point where your weighted average cost of capital increases because you have to issue new common stock. So remember, when you issue new common stock, there's flotation costs associated with it. And so the idea here is that if you invest in projects less than this breakpoint, below this breakpoint, the weighted average cost of capital will be lower. Once you hit this breakpoint and then exceed it, and you invest in projects beyond this breakpoint, the firm's weighted average cost of capital will increase. And so let's look at an example. A firm is considering investing in the following projects, A through E. The costs are listed there and the rate of return is listed there. Let's go through the footnotes of the problem. It says all projects are of average risk compared to existing projects in the firm. Ooh, that's good to know. That makes the problem much simpler because all we have to do is compare the weighted average cost of capital that will be given below to the rates of return that are listed for each project. There will be no risk premium adjustments on the weighted average cost of capital. So we're just going to look strictly at the weighted average cost of capital, not add anything to it, not subtract anything to it. And in doing so, it's a rather clean analysis from that perspective. Now let's continue with the rest of these footnotes. So the rate of return listed includes all revenue and expenses associated with the project except financing costs. So what it's saying is this rate of return here for each of these projects reflects all revenue of each project and all the expenses of each project, excluding the financing costs associated with each project. If that's the case, how does financing costs get included in the analysis? Well, it's relatively simple. We're just going to compare the rates of return versus the weighted average cost of capital, which we'll find out below is 9%. And so what we're going to do is simply compare the 9% versus those rates of return, so that when we look at those rates of return, which reflect all revenue and expenses except financing, and the weighted average cost of capital is where financing comes into play, then we'll be able to interpret whether or not the projects are profitable simply by knowing whether the rate of return is higher than the 9% weighted average cost of capital. Let me continue with the footnotes here. The third footnote says the firm has net income of $68,571.43. Its target capital structure is 30% debt, 10% preferred stock, and 60% equity. Adds up to 100%, so you always want to check that. And it maintains a payout ratio of 30%. The first question says, compute the firm's retained earnings breakpoint. Okay, let's do that. The breakpoint. It's going to be 1 minus the payout ratio, and the payout ratio is 30%. Right here, this 30%. And net income here is 68,571.43 divided by the target percentage for equity, which is 60%. That's the equity fraction right here. This comes out to be $80,000. Now, how do you interpret that? That's an interesting question. And it's a point where the textbook seems to fall down and doesn't do a very good job. So let me give you a little better description of what's going on behind the scenes with this $80,000. Because the way it's written and the way it's described, for example, let me show you. It's called a retained earnings breakpoint. So it gives you kind of the message that it has to do with retained earnings, and it certainly does. But it kind of tells you and suggests that maybe this is all retained earnings, and that's not what we're saying here. That's not retained earnings. And so what I want to do is explain what that 80,000 is a little better. So that $80,000 represents the change in the firm's total capital structure as a result of adding retained earnings. Just doing its normal business. When a firm has operations and it's profitable, it adds to its retained earnings typically. And when it does that, it increases the equity of the firm. And if you want to maintain a target capital structure, in this case 30-10-60, then if your equity increases, you have to increase debt and preferred stock in order to keep the 30-10-60 weights the same. That's what we need to look at a little more carefully. So let's look at it this way. Here's 80,000. This is the change in debt, preferred stock, and equity. That's the total change in capital structure. Now, we know that this represents a change in equity, a change in preferred stock, and a change in debt. And so let's see what's going on behind the scenes. What we're going to do is we're going to take this 80,000 and we're going to multiply it by the target of 60% for equity. And this comes out to be $48,000. That is the increase in retained earnings. That's this number right here. This number turns out to be $48,000. 70% of $68,571 is at 48. Another way to compute it is it's this break point times, which is the break point is the change in your total capital structure times 60%. That's the increase in retained earnings. Now we need to see what the change in preferred stock is. Well, that's computed as 80,000 times 10. That's 8,000. So preferred stock has to increase by 8,000 also. And how much does debt have to increase? Well, debt has to go up 24,000. When you add these together, you get $80,000 change in capital structure. So this 48,000 comes from retained earnings. But where does this come from? Well, that's again where the textbook kind of falls down in its explanation on how this works. It kind of just happens. It's happening behind the scenes. It just kind of happens. And we assume that the firm increases its debt by 24,000 and it increases its preferred stock by 8,000, and we go on our merry way to solve the problem. But how do we get there? How can we just do that? Well, if you remember in the text, this entire chapter, for the most part, there could be some minor exceptions, but with particular problems at the end of the chapter. But for the most part in this chapter, we assumed that debt had no flotation costs and preferred stock had no flotation costs. What that means is the firm can just increase debt by snapping its fingers. And debt increases, preferred stock increases costlessly. It happens behind the scenes But if the firm wants to maintain this target capital structure, 30, 10, 60, and this is growing just because of retained earnings, then these guys have to increase, but they're increasing behind the scenes. So that's, I think, an important concept for you to know in this analysis. Now let's go back and work on part 3, because we've just worked on 1 and 2 here. Part 3 says, assume the firm does not want to issue common stock and that the weighted average cost of capital under these circumstances is 9%. Which projects should the firm invest in and why? Okay, let's come back up to here. And I'm going to call this weighted average cost of capital. It's kind of like a hurdle rate, from the perspective that these rates of return have to exceed the weighted average cost of capital of 9% in each case in order for the firm to accept the project. And so let's look at that. And I'll put here, accept. So let's look at the first project, A. It has a rate of return, all its revenue minus all expenses except for financing, of 17.4%. Compare that to the financing costs of 9%. Ooh, that's an 8.4% gain in profitability in terms of rates of return. And so that's an acceptable project. It's profitable. Well, 16 versus 9, that's 7% extra return. So that's profitable. And then, let's see. C is 14.2 versus 9. That's yes, and that's yes. Doing the same type of analysis. And so all projects here are acceptable because they're all profitable. So that's good. But don't forget this 80,000. This 80,000 is your increase in total capital structure, which means there's $80,000 available now because the firm borrowed $24,000 in debt, issued $8,000 in preferred stock, and gained $48,000 in retained earnings. It now has $80,000 to finance projects. And so it can finance, and it'll look at the most profitable projects first, and that's A, B, and C. And look, A, B, and C add up to $80,000. So all these projects are acceptable, but given the budget constraint of $80,000, we are only going to invest in projects A, B, and C. That is a nice, clean problem. There's no premiums, discounts associated with the weighted average cost of capital. That made it clean. And then it was clean in terms of a nice, easy cutoff of $80,000. There's no money left over. We're not overspending. And so that's pretty cool. Now, the next problem that we're going to work on is a little messier. It's just not as clean as this first one, but it's still quite manageable. So let's look at the problem. Suppose the weighted average cost of capital for pair is 10%, and that 3% risk premium is added for projects that are riskier than average, and 2% is subtracted from the weighted average cost of capital for projects that are less risky than average. So average projects have what I'll call a hurdle rate of 10%. And what we'll see here is that higher than average risk projects have a 13%, 10 plus the 3, 13% hurdle rate. And if you're low risk, if projects have low risk, then the hurdle rate will be 10 minus 2 will be 8%. So here's the projects A, B, C, D, E, and F. Here's the costs and the rate of return. Remember that what that rate of return is. It's the revenue from each project minus all its expenses except for financing costs. And we bring financing costs into the analysis by using the weighted average cost of capital and these risk premiums. They're added or subtracted. And we have risk. So now we can easily compute the hurdle rate for each one of these projects. So first off, we have low risk, which means low risk means it's 10 minus 2, the weighted average cost of capital minus the 2% risk premium deducted. The hurdle rate is 8%. I'm calling that a hurdle rate because what I'm saying is that the project has to earn a rate of return greater than the risk-adjusted cost of capital, and that's 8%. So it is. So 13 is greater than 8, so that's a good project. So let's hold off on whether it's good or a bad project at this point. Let's calculate these hurdle rates as we go down. Now, an average project should get a hurdle rate of 10, the weighted average cost of capital. A high should get 13. 10 plus 3 is 13% as a hurdle rate. An average gets 10, high gets 13, a high gets 13. So the first question says, which projects are acceptable for PAIR at this point? There's no mention of any constraints. So which projects are acceptable? Well, let's compare. The rate of return 13 versus a hurdle rate of 8, it certainly clears it by 5 points. So yes, A is acceptable as a project. B, but B doesn't clear the hurdle rate of 10% because it's only earning 9, so that's no. C only earns 11 versus a hurdle of 13, so that's no. And then D is 12% versus 10. Oh, that's yes, because that's earning a 2% higher than the hurdle. E is low, so we say no. And then F is attractive because it's 14.5% versus the 13, so that's yes. So based on these results so far, A, D, and F are acceptable. Now the next question says, if the breakpoint happens to be $10, which projects will be accepted? Oh, now we have a constraint. And let's see if the constraint holds actually first before we do anything. So let's see, A has a cost of 3, and D has a cost of 8, and F has a cost of 4. Ooh, we can't invest in all these because we only have 10 million, or 10, just call it $10. So let's look at some other information here. The return, so this is 13, this is 12, and this is 14.5 according to this column. So now when we look at it, again, things are still not that clean. We can invest all of our money in D. Well, we can invest 8 in D and to have 2 left over. You'd have to invest it somewhere else or leave it uninvested. And then we could, if we don't pick D, we could go A and F, because A and F add up to 7. And then we'd have $3 left over that goes uninvested. Well, if you look at this, A and F look like they have really good returns. Higher returns than D. So on the surface, and given the information in the problem, let's just go with A and F because they fit the constraint and they have really good rates of return relative to D. So the answer to 2 is A and F now. So we crossed one out with this constraint. Now the third question says, assume that PAIR is committed to investing in all projects selected in Part 2. So it wants to invest all projects in Part 2. So it's anchoring on A and F. So there's no new decision that has to be made because they've made up their mind that they're going to do A and F. Now, the rest of this question says the firm estimates that its weighted average cost of capital will be 11% if it has to issue new common stock to finance additional projects. The firm will be able to issue enough common stock to fund any and all projects listed above, if it deems each is worthwhile. Which additional projects will it accept? Well, now it has a new hurdle rate, and I'll put it in this color here. A new hurdle rate based on the fact that they have to issue new common stock. And the hurdle rate's going to be the same hurdle rate that we had before, but up 1. And before we go further, we can cross out B, because that's not acceptable. And we can cross out C, and we can cross out E. So the hurdle rate for A will be now 9, and the hurdle rate for D will be 11, and the hurdle rate for F will be 14%. So now, which project should it accept? Well, let's see. 13 is higher than the 9. Yes. Let's see. 12 is higher than 11. Yes. 14 is higher. 14 and a half is higher than 14, so that's a yes. So If the firm is going to issue new common stock, it's going to invest in A, D, and F. And it's going to have a total cost of 3, 8, and 4. That's going to be 15. It will have to issue $5 in common stock. New common stock has to be issued worth $5. $5 billion if you want. If you want to add a bunch of zeros to this problem. Let me provide some concluding remarks about this problem. This problem presents a nice segue into capital budgeting, the next topic we'll be covering. This problem had projects, risk, cost of capital, which is the opportunity cost of money. It had the cost of the projects, which represent the size of the project. This is all important information that we need for capital budgeting. However, the problem had some downfalls, and you may have noticed them. The length of the projects were unspecified. We really don't know if the projects were going to last 1 week or 20 years, in which case it could have a big impact on the projects that we select. And related to this issue is we really didn't know how to rank these projects, and so there was a little bit of ad hoc selection in part 2 of the problem, where we selected projects A and F. A little more information would have helped in making that decision, such as the life of the project I mentioned a minute ago. That has a huge impact on the profitability of the project. We'd also want to know how are these returns calculated, and when are the cash flows generated? Are the cash flows generated early on in the project, or are the cash flows generated towards the end of the project, say 20 or 25 years down the road? All those are important factors in determining whether or not a project is acceptable. So what we need is a set of criteria to be able to evaluate projects. That's where the next chapter comes in. The next chapter is going to give us a clear set of criteria and methods for determining which projects are acceptable and which are not.